Sounding a note of caution, the U.S. Central Bank has decided to keep its key interest rate where it is for now. The Federal Reserve increased rates for the first time in a decade in December. The Fed did signal concern about slowing global growth and financial market volatility, but was non-committal on whether those worries would derail its plan to gradually increase interest rates. The three major averages all closed down more than 1% on that news. CCTV's Karina has more.
When the Federal Reserve raised rates in December, Chairwoman Janet Yellen said, quote, "The Fed's decision today reflects our confidence in the U.S. economy." Less than a month later, confidence was severely lacking in global stock markets, which hemorrhaged on concerns about China and volatile oil prices. Market expectations for rate hikes changed, with traders now betting there will only be 2 this year and none before June. Some economists, like Robert Brusca, think the recent market upheavals won't deter the Fed. He thinks the next rate hike will be in March.
And so I think as far as a lot of people on the Fed are concerned, the economy doesn't look half as bad as people who are looking at the Dow Jones Industrial Average. And the Dow Jones Industrial Average is not the economy.
The Fed said economic data in the U.S. will drive its decision, but financial analyst Michael Woolfolk is skeptical.
What's motivating the Fed is not so much the data itself, but rather a desire to get to a terminal rate at which they could respond to a coming recession.
Woolfolk expects at least 3 rate hikes this year. He says rising U.S. rates have a negative impact on emerging markets, particularly Brazil.
If rates rise here, it makes it more difficult for Latin America and other emerging markets to borrow money.
It also makes the U.S. dollar stronger, which makes it more costly for emerging markets to service their existing dollar-denominated debt. When rates rise, money also tends to flow away from emerging markets and into developed markets because investors now can make more money there with less risk.
But rising rates can also have a negative impact on the U.S. economy. When the dollar rises, it makes U.S. exports more expensive, which can hurt its manufacturing sector. And we've already seen signs of that happening. Manufacturing in the U.S. has contracted for 2 consecutive months. Karina, CCTV, New York.